and most of all, use us as agents for the kingdom of heaven. In Jesus' powerful name we pray. Amen.
Amen.
Amen. All right. Thank you, Ray, very, very much. And welcome to everybody here. We're so glad that you have joined us, and I expect more people to be signing on. Let me take a minute to share my screen real quickly. Good. Adele, is that up there?
You can increase it. I am.
Let me see if this will do that.
Yep.
Good. Okay. All right. So the topic for this evening is managing and lowering your tax bills upon retirement.
Phil, can you try again to put it in full view?
Let me see.
Yes, now
okay.
It's good. Go ahead.
Okay, good, good, good. So we're excited that all of you are here. Just a brief introduction. Our staff, myself, Andrew Elliott handles all of our accounting, Luis Reyes, Adele Galvis, Maria Pino. We are all here to serve you. We are certified by the NAD to do what we do. We go through a very rigorous training course that lasts, now it lasts almost half a year. That's not full time, but it starts in August and finishes in December. And but those of us that took the course previously, it was a 3-week intensive program, but then we're required to have continuing education every year. On top of that, our department is audited every 2 to 3 years, depending on how well we did in the previous audit. If we didn't do too well, then they come back in 2 years. And I am very glad to say that we have rated a 3-year rating pretty much for as long as I can remember. So we've done very, very well, and I'm thankful to the Lord for that. Disclaimer, although we are certified as trust officers by the NAD, we are not attorneys, we're not CPAs, and we're not licensed financial advisors, although our speaker tonight is, but the rest of us are not. So anything that we say is not to be construed as legal or tax or financial advice. However, our training and our experience has enabled us to provide some really, really good general information, and then we're able to refer you to professionals in those particular disciplines when needed. Some housekeeping rules. If you would, please keep your own computer muted. We ask you to do that because you never know when the doorbell is going to ring or the cat or dog are going to go off. And so that the rest of us are not disrupted by that, we would appreciate it if you kept your microphones muted. Additionally, we welcome your questions. We're thrilled to have your questions. So, but we ask that you type those into the chat button. If you'll look at the bottom of your screen, there's a little box that says chat. And if you'll click on that, another box will open up and you can type whatever you like there, a question or a comment, and that will be seen by us, and we'll be able to route that to our presenter and get those questions answered for you. Membership has its privileges. Membership in the Seventh-day Adventist Church actually has its privileges. And a few of those are, well, a free consultation with one of the NAD certified estate planners that I introduced earlier. This includes free preparation of your basic estate documents consisting of a power of attorney, a last will and testament, healthcare surrogate, and living will. and some other additional documents as well. If you were to go to an attorney and have this prepared yourself, you would spend anywhere from $700 to $1,000. We offer these services free, and it's just a part of the stewardship that the conference offers to its members. And there's no obligation. Many people do decide to include their local church or another ministry or even just the Florida Conference in their estate plans, but there's no obligation to do so. We're happy to help you. We realize that different people are in different places in their lives, and some are able to do that and some are not. And either way, we're happy to help. Of course, we notarize all the documents, and then when you actually do get to meet with the estate planning attorney over the phone, and you have their complete confidentiality. You can tell them anything and ask them anything. And again, that's all included at no charge. There are additional things that are included. I won't take the time to go into all of those tonight, other than I do want to mention our charitable gift annuities, because payout rates are now as high as 9.7%. And they may even go up again as interest rates are going up. Rates will be adjusted. If they're going to be adjusted, they'll be adjusted January 1. The payout rate is based on your age. This is one time when being older is a good thing, because the older you are, the higher your payout rate is. And those payouts that you would receive are good for the rest of your life. They don't ever end. So let me interrupt myself right there and kind of go to the diagram and say that number one shows a individual gifting property. We call it property. We normally mean liquid property, such as cash or appreciated stocks. And then it can be either a deferred gift annuity or an immediate gift annuity. And immediately income starts coming back to the donor each year, and usually it's divided up quarterly, but it's called an annuity because it's based on an annual payout. That payout goes back to the donor, and additionally they will usually, again, I can't give tax advice, but usually they will receive a tax deduction for a portion of the gift that they have made. And so you get the tax deduction and begin receiving a fixed income amount, which will stay that way for the rest of your life. Once you pass away, any remaining balance then goes to the church. So it's a great way to increase your current income. It's a great way to receive a higher payout rate. I know CD rates have gone up, but they're nowhere near 9.7%. So this can be a really good thing for people. The minimum amount to do this is $10,000. And as I mentioned, you may defer your payouts until later in life, and then proceeds support the Florida Conference or a ministry of your choice. I want to introduce our speaker. I'm so excited to have Jose with us again. He presented to us one time last year, and it was not last year, earlier this year. It was a great presentation, and we all learned a lot. You can see his credentials there. He's been in the financial services industry for over 16 years, earned multiple industry awards, and is a member of the $1 Million Roundtable. And he is one of us. He speaks our language, and he knows what our hearts are and what our priorities are. So I am so pleased that he is with us again today. And so at this time, I am going to stop sharing my screen. And Jose, I'll welcome you to share yours.
Perfect. Thank you, folks, for that nice introduction. It's nice to be back. I think the last time I presented was maybe like, what, 4 or 5 months ago. You know, I cherish the time to be able to educate and teach and share knowledge, right? I think the better prepared that we are for things like retirement, the better off we will be. So let me now go on and share my screen. Let's see. All right, you sure we'll be able to see that? Perfect. So the topic for today is reducing your taxes for retirement. The reason that I wanted to talk about this is I feel that is a very important topic that can impact many different facets of your retirement planning. Okay, as we will see in the presentation today, everything from Social Security benefits, Medicare premiums, of course, your income, right? Because the more taxes you have to pay, the less income you will have. So it does affect a lot of things at retirement. But unfortunately, tax preparation for retirement is often overlooked. There are many things we plan for when we're talking about retirement planning. The easiest thing everyone knows is the accumulation phase, right? Try to put as much money as you can away into some type of plan, whether it's out to 401k, IRA. But then we got to talk about other things like distribution, right? So how do you get your money out? Phil mentioned one of the ways that we do that with annuities, right? That's a way to distribute your assets at retirement and have an income for the rest of your life. Then we have to deal with benefits. So what happens to your health care, long-term care, Medicare, life insurance, some of these benefits that you lose when you stop working, right? So that's benefit planning. And then taxes, right? So preparing for taxes and doing tax planning for retirement, I believe, is a very, very important topic. Today, we're going to touch on two particular solutions that I use in my world when I plan for retirement. And again, these are suggestions and they kind of can be applied differently to everyone because everyone has a different situation. If you want to know how these can be applied to your specific situation, feel free to reach out. You have my information that was given in the beginning. So how do taxes affect retirement? Let's take a look at that. So one of the things that taxes that are not under our control is, no one knows where taxes are going to be in the future, right? Whether that's 5, 10, 20, 30 years from now. Will tax brackets change, right? Will some laws change, right? With the debt that this country has, where are they going to get the money to pay for all these things? So because we don't know where tax brackets are going to be in the future, a wise thing to do is to have money put away someplace that cannot be touched by taxes, right? So that's what we're going to talk about today, how to control that at retirement. Social Security, okay? So for those that are more familiar with Social Security, you do have something called your full retirement age, which for most people is age 66 or 67, depending on when you were born. Now, if you take your benefits before your full retirement age, age 62 being the earliest that you can take Social Security, you do get a deduction, a permanent reduction in benefits. But if you do that and you happen to still be working, okay, if you earn more than $21,000, 21,240 is the number for 2023, then they will withhold $1 for every $2 that you go over that income limit. Okay, so if you're planning to take Social Security early, having a pot of money that is income tax free will be a helpful thing, right? To not fall into this predicament here. Once you are taking Social Security benefits, those can also be taxed. And again, it does go back to how much income or taxable income you report. Okay, so again, having less taxable income. It's helpful in avoiding some of these taxes on your Social Security benefits as well. Okay, so again, tax is the key word for today. Your Medicare premiums. So the Medicare premiums that you paid are also tied to your modified adjusted gross income. Okay, so again, having assets that are not taxable will help you to reduce some of these costs at retirement. And this is why I feel it's so helpful to prepare for these things ahead of time. Now, every dollar that you contribute to retirement goes through three phases, okay? One is your contribution, one is your accumulation, and one is your distribution. Now, you do have to pay tax at one of these times, but you do get to decide which one. So that's the key. We do have to pay tax at some point, but we get to decide which one of these based on which investments we choose. Okay, so let's take a look at these different investments and where they fall into these categories. So I like to use this graphic of the different type of tax buckets. First, we have your taxable investments. Okay, so your stocks, your bonds, CDs, your savings, your mutual funds. We call these taxable because they pay tax on the earnings every year. So as they're growing, you pay tax on the earnings that they make every single year. Then you have your tax-deferred investments, and these are the ones most people know. Your 401ks, right? You at work, your IRAs, different types of IRAs, SEP-simples. You have profit sharing agreements, annuities. Now these tend to pay tax at distribution, right? That's what we call them, tax deferred. So you don't pay tax today, but you will pay tax when you take a distribution in a retirement. And then you have what we call the tax-free bucket. And there are two things that fall into this category. These are Roth IRAs and permanent life insurance plans. So they work very similar. We're going to take a closer look at these two types of plans so you can see how they work in more detail. So we'll start with a Roth IRA. So with a Roth IRA, you can contribute up to $6,500 every year. You can do this lump sum, you can do this monthly, really however you want. $6,500 every year. And if you are over 50, you do get to put in what's called a catch-up contribution. Okay, so right now we are at $7,500 total. So it's $1,000 over your regular contributions. Now, for those that are in higher income brackets, you are phased out of being able to put money into Roth IRAs. Okay, so again, if you have a question particular to you, feel free to reach out to me. We can talk about this as something feasible to you. But most people can contribute about $6,500 into a Roth IRA. Roth IRA distributions are not counted for your taxable income when it comes to calculating your Medicare premiums. So again, at retirement time, having money in an account like this will help lessen the impact of taxes, specifically for your Medicare premium. So that's a big plus. Now, most people will purchase something like a mutual fund inside a Roth IRA. And as we all know, mutual funds their performance is based on market gains, right? So however the market does, that's how the funds go, right? The markets make money, you make money. There is an element of risk, right? So if the market loses money, then your account can temporarily lose money. So you assume that risk when you are participating in something like a mutual fund inside a Roth IRA. They usually pay small amount of fees, right? Because it's really just an investment product, right? Mutual funds. So most of your money can be going to work in these funds, okay, with a Roth IRA. But they do fall under IRS regulations, okay? So what that means is, I just gave you one example here, which is you can only put so much every year. If you have more money to put in here, you really can't. Also, if you touch your funds before age 59 and a half, then you do assess some penalties, okay? And also, if you are in a higher income bracket, there may be a possibility that you can't contribute to a Roth at all, okay? So that's what we mean by IRS regulations. There are some limitations, but as long as we play with within these confines, then we're good to go. But there are some limitations. Of course, you do get to enjoy tax-free withdrawals. So again, the earlier that you can start a plan like that, using the power of compound interest, the better off you will be, because you can take tax-free withdrawals at retirement. Now, a very common question, and I think a misunderstanding people have, is whether they can have a work retirement plan and a Roth IRA at the same time. So the answer is yes, most people can contribute to a work retirement plan and have a personal Roth IRA. Now, again, the annual income bracket limitation comes into play. I believe 150 for single filers and 193 for married. If you're over those brackets, then you do have some limitations. Okay, but most people can have a a Roth IRA with a retirement plan. There are some work plans that actually offer a Roth option. So this is a good way to bypass those income limitations. You can ask your provider at work if they have a Roth IRA, a Roth option, and you can contribute to a Roth and your traditional 401k at the same time through your work plan. Okay, so that's another way to do this. Now, the second option that I wanted to discuss today is permanent life insurance. So permanent life insurance can be a viable alternative for a Roth IRA. And you're going to see that they have very similar benefits. So money inside a permanent life insurance plan can be tax-free, structured properly. And in a minute, I'm going to go into an example to show you what that looks like. So tax-free income, very similar to a Roth IRA. It is creditor protected, just like annuities and retirement plans. So in the state of Florida, if you get sued, people can't touch that money. So that's something that's very useful, especially for business owners. Some of these plans, and I'm trying to keep it general here because there are many types of plans, but some of these plans will protect against market losses. Some of them give you either fixed guaranteed rates. Some of them will say, if the market has a negative year, we just don't give you any credit, but you don't take a loss. That's another example. So again, you can have some protection against market losses. You have higher contribution limits than an IRA, right? Since we don't have to necessarily abide by IRS rules, you can put more money in, and you don't have to worry about the income limitations as well. So same thing. No IRS rules apply to these types of plans, so you can have higher contributions. You can take money out early, right? So if you plan to save early enough, you can take money out early, no penalties, creditor protection. So again, you have it adds flexibility to your retirement plan to have money in one of these vehicles. And then, of course, because we are talking about life insurance, you do have a tax-free death benefit, right? So a death benefit is always tax-free in life insurance. So on top of all these things, you can enjoy a tax-free death benefit that will be, or have the peace of mind that that's something that would go to your heirs, right? And that adds value to the investment. So it is a very flexible tool, right, for the right person. So someone that, for example, is planning for an early retirement, right? And they want a source of income that they can take without penalty before your normal retirement age, this could be an option. Someone that wants to have a death benefit, whether it's an inheritance for their children, or whether it's protection in case of a premature death, right? Because we are talking about life insurance, so we'll have that tax-free death benefit. And someone that say can't contribute to a Roth IRA because of income limitations, this is a very good alternative to that. So I wanted to take a look at an example of how this looks like in numbers so that you guys can see this in action. Let me share another screen with you. All right. So here's a generic example of what this looks like. Okay, so we have here just a general 35-year-old male who's in good health. In this scenario, we purchased a policy that has a death benefit of $250,000, right? And you have a premium of $6,000 a year. I chose 6,000 because then it looks similar to what you will put into an IRA. Okay, so $6,000 a year, you have a death benefit of $250,000. So let's take a look at how this does. Again, I'm keeping it simple and general. This can be applied in different scenarios. And if you want to know how this works in your case, let me know and we can talk about it. All right, so this gives us kind of the accumulation and the earnings. Okay, and we're basing this on a 7% rate of return, which these plans have averaged over the last 20 years. Here you have your annual premium. Here you have your accumulation. So this is how much money you fit out of your pocket. So we can keep track of how profitable this is, right? So this is adding every single year 6,000. And you have your value. This is the value the policy has. And this is how much money you can actually touch. Now you notice right away that this money is less than this column here. The reason for that is that you do have some limitations as to how much money you can use during the first 15 years of the policy. So these things are always long-term investments because you do have limitations how much you can use. Now, it doesn't mean you can use anything. It just means that you have some limitations. If you look at year 15, all of the money that you have in the policy is yours to use. Okay, so in the beginning, you have limitations. At year 15, basically, the policy becomes liquid for cash purposes. So this person continues to pay their $6,000 all the way towards retirement age. Okay, at this point, at age 65, he would have put in $180,000 of premium from his pocket, and the accumulation value that he has will be roughly about $500,000. Now, at this point, you don't really want to just cash out and take everything out all at once, because then the policy would die with it. So what we're doing in this case, we're going to take some income out, okay, in order to keep the policy active. So at this point, if you see here, we stop paying premiums and we start taking out income. Now, this is tax-free income coming to you, similar to a Roth IRA. So we're taking out $35,000 a year, income tax-free. We do this for a total of 20 years. Okay, so now he's age 86. At this point, right, if you just multiply 35,000 times 20, you have $735,000. So again, his contribution is $180,000. He has taken out $735,000 tax-free so far, okay? At this point, we still have a life insurance policy, which means we still have a death benefit, okay? So we stop taking money out, we just let the policy run, and in this case, there is a death at age 90. So, life expectancy, right? At age 90, there's a death. So you have a death benefit of $440,000 that now gets paid out tax-free to his heirs. So the total numbers for this is he invested $180,000 out of his pocket, got out during his lifetime $735,000 of income tax-free. And on top of that, we got a death benefit of $440,000, making his total cash out $1.1 million. Okay. So again, this is an example of what can be done with something like this. So it's a little bit, I guess, more flexible and a little more complicated than a Roth, but it can add a lot of flexibility to your retirement planning, apart from giving you also a death benefit, money for early retirement, and so forth. Again, I wanted to just do a very, very general overview today. If this is something that seems interesting to you guys, then feel free to reach out to me and we can always talk about how it applies to your specific situation. All right, so now I'm going to open it up for any questions. I don't know if any came in.
We did have a question come in on the chat. Let me go up to that one. You use the term defined of combined income. Could you define that? Does that mean Social Security and anything I earn, or combined household income?
So this is, I think we're looking at the modified adjusted gross income calculation.
Yes.
Let me go back to
Feel
that.
free to pull your slides back up. That might trigger some questions. In fact, I had a couple that were dealing with one of the slides.
There you go. Let me go back here. So I think I was talking about how Roth IRA country distributions do not count towards your calculation for your modified or adjusted gross income. I believe this is a combined calculation in your tax returns. So this is something that there is a specific line you do want to get with your tax professional, so they can point you to where your modified adjusted gross income is. But the point of all this was this does not count towards that calculation, right? So the lower the income that you have here, the better you are for many reasons.
So in other words, those distributions, whatever you take from your Roth IRA, and I understand there's no RMD, there's no required minimum distribution on a Roth. Is that right?
Yep, that's correct. So what that means is at age 72, on the regular traditional plans, you must take a portion of them if you haven't taken any out, because the government wants to get its taxes. These are for things that are tax deferred. With a Roth IRA, you do not have to do that. Therefore, you actually can continue to let it grow if you don't need the money. So yes, thank you for that.
So I have heard of an idea. I've never seen anybody do it, but I would love to see somebody do it, and maybe I'll do it one day. But let's say, but you're the expert, so tell me if this is feasible. Let's say that I want to give a gift to my local church of $5,000 every year. And I'm doing that right now, let's say. But let's say I want that gift to continue even after I have died. So how could I do that? Well, if I were to take out a life insurance policy with a death benefit of $100,000, and let's assume that when that 100,000 pays out, somebody could invest it and get a 5% return, which is not terribly high. And 5% return would be $5,000. So, Jose, could I take out that policy while I'm still alive, $100,000 policy, and I pay the premiums on that? But I make the church the beneficiary. And so when I die, the church would get the $100,000, and I would restrict that so that they would only get the earnings. They wouldn't get the lump sum 100,000. And taking it one step further, let's see. So number one, could I do that? Or number two, could the church take out a life insurance policy on somebody, and where the church pays the premium, but maybe the donor would donate that same premium amount each year, so that the church is really not out of pocket any. Are you understanding what I'm saying, or does it sound completely crazy?
No, so in the business world, there are instances. So let's treat the church as a business, right? For this example, where the business takes out a life insurance on someone and pays the premiums for it. And the death benefit can go right back to the business, right? Tax free. So that can be done. It may take some a special structure, right? But I've seen things like that done. Back to your original scenario of buying a life insurance to then fund an investment that would pay out an interest that can go back to the church. That can be done putting the lump sum obviously into an investment plan or even an annuity. With an annuity, you do have a payment for someone's lifetime. Okay. Another thing that I've done with clients is leaving your taxable investments to a charity like a church. When you do that, that money actually becomes tax-free to the church because it's a nonprofit. Okay. And then taking money from say life insurance and other things for themselves, but leaving taxable assets to a charity, and those distributions become tax-free. So that's another way to do it, to benefit the church, let's say, and save on taxes as well.
So that's a very good point. And I have had occasion to help, church members think that through, where if they're going to leave, something to the church or any other nonprofit for that matter, and they're also going to leave something for their kids, which is, very natural and desirable. So rather than just doing a will where they, have it all go into one lump sum and then it's, has tax consequences to the kids, you could have the kids receive, just exactly like you just said, kids receive assets that were pre-taxed or previously taxed, or insurance benefits so that they're not taxed.
Correct.
And then leave your philanthropy, use your taxable assets for your philanthropy.
Yep.
And that way, since the nonprofit doesn't have to pay taxes, it spares those taxes all the way around.
Correct. Yep. That's the way to do it.
Now, I think there may be some questions on the chat. Adeli, could you unmute and help us with that?
Yes, we have two questions. So Barbara is first and then Jennifer. So Barbara asks, once you retire, does it make sense to explore a permanent life insurance plan?
So that depends on your specific situation, right? So if your goal is to leave an inheritance that is tax-free, it may. Now, if you're thinking about it from a standpoint of once you're retiring, can you start to invest for a future income? It may not be the best platform, right? Because these things do take some time to accumulate. So that's why these things are very good in specific scenarios. So again, for life insurance, you always think about life insurance as a way to leave money to the next generation tax-free. So in that sense, yes, you can do it even at retirement, but I would say as an accumulation piece, it might not be the best.
Okay.
Because it has a life insurance fees.
Okay. So Jennifer, go ahead. You raise your hand. Go ahead and ask the questions. You can add in unmute yourself.
Thank you. I was the one who asked the question about the combined income. It had to do with Social Security. It was back on your Social Security page, and you're talking about how much you could earn.
Right here.
Yeah, right here, where it says up to 85% of Social Security benefits can be taxed based on your annual combined income. Is that combined income household, or is that just talking about if I'm working and I'm getting Social Security?
If you're working and if you're getting Social Security, they're gonna look at your income. And I believe there's still calculations if you're single or married. So again, this is something you probably want to direct to your tax advisor.
Okay, thank you.
Okay. So we had another question here. Let me see. Will investing in tax-free minimum bonds keep Medicare payments lower? Will it prevent higher taxes on other income?
So if
Municipal bonds.
if those things are tax-free on the way out, it should. I work mainly with them in the mutual fund world. So you may want to also talk about whoever you're dealing with for these specific vehicles for more tax details on how it will affect. But the general rule is if they're tax-free on the way out, it should help you, and it will be a similar effect to what I've mentioned here.
Okay. Any other has questions?
Jose, could you go to your either last slide or second to the last slide? There was something, I had a question there. These forms.
The next slides, probably.
Yeah, maybe it was here. Yeah, I think it was here. Oh, I think I just wanted to make the comment that it really is nice when one inherits, tax-free assets. I've had many clients be surprised because they have inherited monies from a 401k or IRA that were never taxed previously by, let's say their mom or dad had a 403b, which is similar to a 401k, and it wasn't a Roth, so it had never been taxed. Well, when the person dies and that the residual goes to the next generation or whoever the heirs may be, those heirs can be surprised to find out that that's taxable to them, because most people are under the impression that inheritances are not taxable. Jose, could you comment on that?
Yes, correct. So that you have to pay tax at some point, and when it's a pre-tax account, like a 403b or 401k, the beneficial will have to pay tax. And I believe you have to do an accelerated payout on them, or you have to take the money out and pay taxes. So yes, a lot, maybe 15, 20, 25, 30% can go away in taxes.
Exactly. Yeah, depending on the individual's income tax bracket. So yeah, that was what my comment was on that slide. Jose, if you'll stop sharing for a moment, and then Adele, do I have? Let me
Yes,
go back
please.
here. Yeah. And are there any other questions? Does anybody have? Please unmute and speak up if you have anything. All right, let's see here. All right, Adele, this slide is not advancing.
I don't know why.
Okay, well, let's try this. Stop sharing and share one more. This is where we were earlier.
Mhm.
Jose, I have a question for you.
So now
What
you
is
can
your what is your recommendation once a person retires and wants to convert their IRA, be it 401k or 403b, into Roth? Any ideas on that? What is the recommendable thing to do? Because I know you have to pay taxes when you do that conversion. And that's why you do it after you retire, right? Because your bracket is lower than when you're working.
Right. So when you do a conversion, you do have to pay tax at that time. So you want to be careful with
How much?
how much you convert, combine that with your income to see what tax bracket you fall into, right? Because you'll be paying taxes on that tax bracket. So that answer is kind of individual for everyone.
Yeah.
Whether a Roth IRA is a Roth IRA conversion, sorry, is something that is advantageous at retirement.
Is there a limit to, for example, now we're limited, but is there a limit once you retire, or you can just convert anything you want from your IRA to the Roth?
I believe you can convert any amount. You have to pay the tax bill at that's that year, right? So you have to be careful and just not do a blind conversion because you'll be hit with a big tax bill.
And you can only convert money that is on IRA, right? You cannot put money into a Roth post tax. I mean, money that you already paid taxes on.
So you can contribute to a Roth IRA, even at retirement time. You can't put money out of your personal bank account into a Roth IRA. Yes.
And you have to pay tax. You have to pay taxes again. So you're paying twice.
No, it doesn't affect your tax calculation. So, whatever you put on there, it gets reported as a contribution to a Roth, but it doesn't affect your tax numbers.
You're not taxed twice on it.
Yeah, you're not.
So
Right.
Phil, if you want to go over, scan your slide.
Yes.
And then if anybody has more questions, then we can leave it at the end.
Well, let's see here. There we go. Yeah, so we certainly want to answer, make sure we've answered everybody's questions. I believe, Adele, you've recorded this. So
Yes.
If there's something that you want to hear again or want to see the graphics on, you can contact Adele. You can email her or call her, and she can give you a link for the recorded version of this. Jose, we certainly thank you so much for taking time out of your evening to educate us, and we certainly want to make sure we have your contact information available for people who have more detailed questions about their individual situation. So we can certainly do that. I do want to mention that we do have a couple of seminars already lined up for next year, and we will be having more later in the year that we will announce. But please go ahead and mark your calendar. We're very excited. Mike Brenog is conducting our next webinar, and that'll be on January 30th. That's a Tuesday at 6 p.m. And it's securing your retirement future, retirement saving strategies. And this is whether you're in your 20s, your 30s, your 40s, on up to your 70s. Mike has got a tip or an idea or two for each age bracket. And so we're really excited for that. And then March 26th, the good, the bad, and the ugly of life insurance. And we're looking forward to that presentation as well. if you need to contact any of us, you can take a picture of this weird looking diagram there. It's called a QR code. And if you hold your camera from your phone up to that, it will take you to a website that you can click on, kind of a cool little thing. But if not, you can always just email us or call us for Florida conference. And then for in Georgia or Southern Tennessee, you can reach Ray at this phone number or this email address. And then Silka, I haven't said hello to you this evening, but hello, my good friend Silka. We're glad you're with us tonight. And you can reach her with any questions or concerns if you're in Northern Tennessee or in Kentucky. And yeah, so that's the extent. Yes. Mm-hmm.
Can you please go back to the slide for Jose information so that way anybody can take a picture right there?
Thank you, Ellie. Yes, thank you so much.
Yeah. In case that.
Jose, I trust you don't mind us putting this up and that you'd be glad to entertain any more detailed questions somebody may have.
Yes, correct. I appreciate that.
Sure. So there's
And
his phone number. Mm-hmm.
And if you had any specific question about your personal situation, feel free to take the phone number or the email and have a conversation with Jose. You don't mind about that, right, Jose?
No, not at all. Happy to help.
Very good. Well, with that, I think we can conclude our call unless anybody else has any final comments for us. And if not, we look forward to seeing you January 30th for our next program.
If you, since I had a couple of here, if you are interested in helping us to promote the webinar, the seminar at your church, please send me an email and I will be happy to send you flyers, to send you an email with the information. And not only you can benefit from this free information, but your members, your friends at the church, they can benefit from it too. And we are working later on, all these seminars are going to be in YouTube. So we are working very hard to upload all these seminars and we are going to put it in our YouTube at Development and Plan Giving Florida Conference in YouTube.
Good deal. Silka, would you close us out with prayer?
Heavenly Father, thank you so much for this time we could spend together to learn more on how to use our money wisely so that we can live longer, live for your honor and glory, and use it wisely the way you want us to use it. Please be with each one of us that's been listening in. Bless our lives, help us to be good stewards, and keep us safe and keep us walking closely with you. In Christ's name I pray, amen.
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 All right, folks, thank you so very, very much. Hope you have a good evening.
All right. Thanks so much. Have a good night.